Welcome to lecture 4 of our accounting series. Today we delve into a very heart of financial reporting, the accounting equation. If accounting is the language of business, then the accounting equation is its grammar. It provides the structure that allows us to record, organize, and summarize every financial event that occurs within an organization. For any graduate students of a business or finance, mastering this equation is not merely an academic exercise, it is the essential first step in understanding how a business maintains its equilibrium and communicates its financial health to the world. Throughout this session, we will explore why this equation must always balance and how it serves as the foundation for the modern double entry bookkeeping system. Before we begin our deep dive, let us outline our roadmap for this lecture. By the end of this session, you will be able to understand the dual aspect system, which is the best philosophical basis of all accounting, explain the fundamental accounting equation and its various mathematical forms, identify and define the critical relationship between asset, liabilities, and owner's capital, analyze how diverse business transactions from purchasing equipment to earning revenue impact the equation. Recognize the pivotal role of this equation plays in the preparation of the balance sheet, the primary statement or supplement of financial position. Every business, regardless of its size or industry, operates in a simple logic. The resources it owns must be provided by someone. These providers are either outsiders like banks or suppliers or the owners themselves. This leads us to the fundamental accounting question. At its core, the equation ensures that every financial transaction is recorded such that the books remain in perfect balance. Why this balance is so critical? Because it reflects a universal truth in business. You cannot have an asset without corresponding source of funding for that asset. Have you ever wondered why a balance sheet is called balance sheet? Because it is a direct physical representation of this equation. The principle driving this is the dual aspect concept. The concept dictates that every transaction has two sides. In every exchange, there is a giver and a receiver. If a company buys a delivery truck or cash, it has gained a vehicle but lost cash. The dual nature of this equipment or event ensures that total value within the system remains constant. Let's look closer at the dual aspect concept. The principle is the bedrock of the double entry system. It suggests that every single transaction affects at least two accounts. This is not just a rule, it is a mathematical necessity to maintain the integrity of the financial data. Think of it as a scale. If you add weight on one side, you must either add same weight to the other side or remove an equal amount from the same side to keep scale on the level. For instances, if a business borrows rupees 50,000 from a bank, what happens? First, the business receives cash and asset. Second, it incurs a debt, a liability. Both sides of the business financial scales increase by the same amount. Bookkeeping is the equation perfectly balanced. Recap के तौर पे, we have established that every transaction relies on the dual aspect concept, meaning every transaction has two sides, a receiver and a giver. This ensures that the fundamental balance of the business is never disturbed. To understand the equation, we must define three main pillars. The first pillar is asset. In formal terms, assets are resources controlled by a business as a result of past events, from which future economic benefits are expected to flow. In simpler terms, assets are what the business owns or controls to generate profit. We generally categorize assets into two types. First, we have tangible assets. These are physical items you can touch, such as land, building, machinery, and office furniture. Second, we have current assets. These are the resources the business expects to convert into cash or consume within a year. This includes cash in bank, debtors, that means people who owes the business money, and stocks or inventory ready for sale. A question: can a business exist without asset? The answer is no. Assets are engine of the production. Without them, a business has no meaning to provide services or manufacturing of goods. The second pillar is liability. While asset represents what a business owns, liability represents what the business owes to outsiders. These are legal obligations to pay money, provide goods, or perform services in some future time. Common example of liabilities includes bank loan, we must be repaid over time, and creditors who are suppliers that provide goods to the business on credit. Other forms includes bills payable and outstanding expenses such as unpaid rent or salaries. Liabilities are not necessarily a sign of weakness. Often they are a strategic tool used to fund growth. However, they represent a claim on the business's asset by someone other than the owner. The third and the final pillar is owner's equity, often referred to as capital. Equity is the residual interest in the assets of the business after all the liability have been deducted. In other words, if a business closed today and paid off all its debt, the money left over would be the owner's equity. Equity increases when owners invest in their money into the business or when the businesses generate profits known as retained earning. Conversely, equity decreases when the owner withdraws money for personal use or when the business incurs a loss. The relationship is explained as assets is equal to liabilities plus owner's capital. This equation tells us the total resources of a company are always funded by either creditor or owners. For recap, assets are resources owned, liabilities are debt owned to outsiders, and owner's equity is the owner's remaining stake in the business. Together, they form a constant balance. As a business moves from its first day to set up into daily operation, the simple equation evolves. We must account for the dynamic elements of business, revenues, and expenses. This leads us to the expanded accounting equation. Revenue represents the inflow of the assets from selling goods or services. Expenses are the cost incurred to generate that revenue. When revenue exceeds expenses, the business makes a profit, which increases owner's equity, which expense when expenses exceed revenue, a loss occurs, which decreases equity. The expanded form looks like this, like assets is equal to liability in bracket capital plus revenue minus expenses minus drawing. By looking at the version, you can see how every cup of coffee sold or every month of rent paid flows directly into the balance sheet. This connectivity ensures that the profit and loss performance of company is always reflected in its overall financial position. Now, let's apply this theory to practical example. How do every event changes these numbers? Consider example number 1. Capital contribution. If an owner invests rupees 1 lakh into the business as a cash, the asset cash increases simultaneously. The owner's equity increased by the same amount. The equation stayed balanced because both sides rose by rupees 1 lakh. Now consider example 2 as machinery, the purchase of machinery with cash. Suppose the business spent rupees 40,000 of the cash to buy machinery. Here, one asset like cash decreases while another asset machinery increases. This is one side effect. The total value of asset remain unchanged and the liability and equity sides are unaffected. The dual aspect here is an internal shift within the asset category. Transition from this internal shift, let's see what happens when we bring outside parties. In example 3, loan from bank. The bank borrows rupees 50,000, that is a cash asset, goes up, but so does the bank loan a liability. Again, the equation balances as both side increases. What about day-to-day operations? For example, 4, revenue earned. A business sells goods of rupees 20,000. This increases cash or debtors and increases owner's equity because revenue is the gain for owner. Theoretical question: if a transaction only affect one side of the equation, what would happen? The answer is simple. The accounting records would break. The fundamental logic of the double entry system would fail, leading to inaccurate financial reports. Understanding the balance between these components allows us to access a company's health, owner's equity, and essentially the net worth of the business. If a company's asset significantly exceeds its liability, the equity is positive and healthy. This indicates a strong financial position. However, a business, if a liability exceeds in a business to asset, the equity become negative. This is a red flag indicating financial distress or potential insolvency. As graduate learner, you must analyze that the accounting equation is more than just a math. It is a diagnostic tool. By analyzing the ratio of debt, that means liability to equity, investors and managers decide whether a business is a safe bet or a sinking ship. How do we practically work out of this equation? How do we practically work out these equations? I recommend a 4-step discipline approach. First, analyze. Second, decide the effect. Fourth, record. And fifth, verify. In analyzing, break down the transactions. What is happening? Is it a sale, a loan, a purchase? Identify which category are involved: asset, liability, capital, revenue, or expenses. Second, determine the specific account are increasing or decreasing. Record, enter the changes into the equation format. This is the most important step. Verify. Always check if asset still equals to the liability less equity. If your total do not match, you have missed a dual side of a transaction or another side of transactions. Do not panic in this. Let us conclude with the comprehensive scenario to see the equation in action over multiple steps. Imagine a new startup. First, the owner invests rupees 1 lakh, asset rupees 1 lakh. So, equity is 1 lakh plus. Second, the business buys a furniture for rupees 20,000. Then what happened? Cash is decreased by rupees 20,000 and furniture is increased by rupees 20,000. Third is bank loan taken while you receive cash of rupees 50,000. Similarly, and at the same time, liability has been increased by rupees 50,000. In fourth example, you have earned revenue or profit of rupees 30,000 by whatever means. It will direct effect. Remember, it will directly affect the owner's equity. So you will receive 30,000 rupees in cash, while on another side, equity will increase by rupees 30,000 also. In fifth example, suppose you pay salaries to your employee of rupees 10,000. So what will happen? Cash will decrease by rupees 10,000 in your business, and similarly, because it's salary, it's nominal account matter, it will decrease also, or it will affect also the equity. Now let's look at the final position. After these five transactions, our total assets consist of cash, rupees 1 lakh minus 20,000 plus 50,000 plus 30,000 minus 10,000 of salary is equal to rupees 1 lakh 50,000. Furniture of rupees 20,000 and total asset is 1 lakh 50,000 plus 20 lakh is equal to 1 lakh 70,000. Liabilities and equities. Liabilities, bank loan was liabilities in this form, rupees 50,000. Equity, capital, revenue minus expenses. The capital was rupees 1 lakh, revenue was rupees 30,000, and the expenses was rupees 10,000. The total is 1 lakh 20,000 rupees. Balance check. Asset is equal to liability plus equity. So asset is rupees 1 lakh, liability is rupees 50,000, sorry. Liability is rupees 50,000 and equity is rupees 1 lakh 20,000. So altogether they are making 1 lakh 70,000 is equal to 1 lakh 70,000 rupees. In this lecture, we have seen that the accounting equation is the backbone of all financial records. It is a mathematical expression of the dual aspect concept, the idea that every economic event has two equal and opposite effects. We have learned that asset represents resources while liabilities and equity represent the claim on those resources. We have also explored how the expanded equation incorporates the day-to-day fluctuation of revenue and expenses. Remember, the equation is the direct precursor to the balance sheet. By maintaining this balance, a business ensures transparency, accuracy, and a clear view of strength of financial strength of your company or your business. As you move forward, keep this balance in mind. It is the ultimate check and balance in the world of finance. We will meet in the next chapter of double entry system. Till then, keep learning, keep revising. Thank you.